Welcome back to FX Streets. It's 8:31 a.m. Eastern. Welcome back, one and all. Great if you could join us. My name's Adam Rosen. Very happy to be here. It's the best. Retail sales are being released at the moment, month over month, 0.8% versus expectations of 0.3%. Much better than last month's negative 0.7% reports. The producer price index in the year-over-year basis is up 0.5%, month-over-month 0.3%. Ex-food and energy, month-over-month 0.4 versus 0.2. Year-over-year 2.5 versus 2.3 expectations. So retail sales and producer price index both handily beating the numbers. And as we can see, as a result of this, stock futures are surging. Gold is moving sharply to the downside. The dollar is, kind of looks like the dollar is actually weaker as other currencies are moving up. The Aussie and the Kiwi look like they're surging. And we have 10-year bond yields, which are probably the most telling. They're up 2.4% on the yield to 170. That's a very, very big high yield. We haven't seen it in quite a long time. Now, getting to the topic of the day, which is sort of ironic because everything ties in. What we're going to do today is talk about the basic essential elements of trading the Forex markets, including, what we talk about, the relationship between economic news, the central banks, their decisions, how their decisions affect the currency trends that we see on the charts. Everything ties in together. Now, completely unrelated or a complete coincidence, what I did was yesterday I put together an article. I'm going to send everybody the link to the article as well, that talks about really the basics. I think a really nice way to consider the basics of of fundamental analysis. And I know I probably tend to focus a lot on fundamental analysis here, but it's important stuff. And I think that technical analysis, I think that a lot of traders really probably have the basics down. We're looking at the pound Kiwi chart right now. We know there's a trend to the downside. We can establish this trend with the trend line, or we can put in some sort of moving average. As follows, here's a 90 moving average. That's too much. And it's pretty easy to adjust that to a 40. And even that's a little bit, maybe we'll move it to a 50. So we can see here, technical analysis is actually pretty easy. We establish a trend, and then we do our best to isolate where's the best time to enter. And we can use the trend lines. We can use the moving averages like we've just seen. We can use the RSI, the Relative Strength Index, that tells us to buy over there and to sell over there. But, technical analysis being so, I don't want to say easy, but so straightforward, why is it that more traders are not consistently profitable? There's three elements to trading. There's the technical analysis, which I think that we probably know the best. There's money management that probably seems very easy, and I think most of us probably mess up at one time or another. 10-year bond yields are up 3% now, the 171, really surging to the upside. And then there's fundamental analysis, which I think a lot of us, and I'll just tell you from my own experience, a lot of us are really kind of probably intimidated. We look at the economic calendar. Here's the FX Street economic calendar, one of the better ones out there. And we look at this thing, and we say, well, what does this all mean? I mean, I know that the PPI number in the U.S. was good today. And I know the retail sales were good today. Well, so that's good. And I can look at, some of the other numbers of the ZOO and the Eurozone, the GDP in the Eurozone, UK CPI earlier today. And it's easy to see if it's good or bad because the numbers are either red or green. But what does that tell me? Does that mean I buy the dollar? Do I sell short the euro dollar? Where do I sell short? How do I know when to close the short? Fundamental analysis, I think most traders are under the impression that it gives us in broad strokes, it paints in broad strokes what we should do. Yeah, generally speaking, the economy in the U.S. looks like it's better than Europe, so I'm going to short the euro dollar. But that doesn't tell us where. It doesn't tell us where to place a stop. And most traders will say, well, that's why you need technical analysis. Because technical analysis, in this case, the pound Kiwi will tell you, yeah, well, there's a trend line. You got to place your stop there. But fundamental analysis can also tell us where to get in and where to get out. Fundamental analysis can find those tops and bottoms of the trends in a very logical manner. And it just takes a little bit of application. I'll show you what I mean. And this refers to an article. I'll send everybody the link afterwards. There's three big elements. I mean, this is economics 101. But in terms of fundamental analysis in the Forex markets, the number one reason why currencies move in anticipation of higher or lower interest rates. Interest rates determined by the central bank. Okay? The economy looks like it's getting better. The Federal Reserve in the U.S. says we're going to raise interest rates. The economy in Europe is bad and it's worsening. The European Central Bank says we're going to lower interest rates. We have 8 different currencies that we trade, and each currency has a respective yield. In the U.S., Switzerland, Japan, in a lot of places we have interest rates basically zero. We have 3.5% interest rates in Australia. We have, 1% I think in Canada, and, it's 0.75% in Europe and 0.5% in the UK. If we have the choice, and forget everything else we know about finance, if we have the choice to put our money into a bank account in Australia and make 3.5%, or to put our money into a U.S. savings account and make 0.25%, the obvious answer is to put our capital in that currency, in that nation that pays a higher interest rate. Why not? I mean, that's where money goes. Money goes for the best return given the same amount, given a certain amount of risk. Okay. Now, if I tell you tomorrow that we're going to have higher interest rates in Australia, that I have the inside information. I'm making this up, of course. There's no inside information in the Forex market. But if I did, and I told you tomorrow, somebody told me that, I got the phone call, the Reserve Bank of Australia is going to unexpectedly raise interest rates, but in order to get 4% tomorrow, you got to be in today. What are we going to do? We're going to rush to the bank and put our money in today. That's essentially how the Forex market works. Capital moves in anticipation of higher or lower rates, because once that central bank raises interest rates, generally speaking, the central bank is it's a last event to occur. Once a central bank raises interest rates, it doesn't mean that's the end of the trend, but there's a lot of things that have taken place in order for that central bank to raise rates. The central banks are very slow-moving steamships. They don't react very quickly to economic conditions. They have to manage an economy. And if the central bank raised interest rates today and lowered interest rates tomorrow, that would create a lot of uncertainty. What's my mortgage? How much can I get a mortgage for tomorrow? How much am I going to have to spend to buy a car tomorrow? That uncertainty is not good for an economy. Central banks only meet every 4 to 6 weeks, and I'm sure you've noticed they actually very rarely adjust their interest rates, maybe only a few times a year under normal conditions. And when they start to lower interest rates or raise interest rates, it's almost as if they go in a campaign. The U.S. had 5.25% interest rates, and within 2 years, we were down to 0. They were on a cutting campaign. But once they cut interest rates, in 2008, 2009, we were at 0. That's where we've been since then. We have not seen one single change in U.S. interest rates in the past 4 years. And that's actually not that uncommon. The European Central Bank cut interest rates down to 1%, and they remained there for, a good amount of time. Former President Trichet raised interest rates and then lowered them. And then the current president of the ECB, Mario Draghi, lowered them a little bit more, and that was a really big deal. A lot of people didn't expect that. But in terms of the central banks watch the economic calendar, the same as we do. Here's the FX Street economic calendar, which is a really good one because it has a lot of different functionality. I like to consider the 3 big economic barometers fundamental. These are what I believe are the 3 big factors that central banks use in their decision to raise or lower interest rates. We have unemployment, which is probably what you can see right now, and we have inflation, CPI, PPI. PPI was earlier today in the U.S. just a few minutes ago, And in the U.S., we also talk about something called the PCE, Personal Consumption Expenditure. And then we have the growth numbers, which are commonly known as GDP, Gross Domestic Product. So what I did yesterday, I got a little bit bored. So I downloaded all this historical information. I plugged it all into an Excel spreadsheet. And I sorted it and tweaked the numbers and, tried to come up with something that looked logical. What we're going to do is we're going to take a hard look at these three big numbers to see how these different currencies stack up against one another. And this is an especially important, and I think really it can be a very helpful exercise in the Forex market. Because when we buy the euro, I say I'm buying the euro, and you probably assume that means I'm buying the euro dollar, because that's a jargon. Or if I say, yeah, I'm buying the euro yen, fine. I'm buying the euro, I'm selling the yen. But trading in the Forex market, we all know that it involves a comparison of two different currencies. I'm buying the euro and selling the dollar. I'm hoping the euro goes up and or the dollar goes down, hopefully at the same time. I will. We're going to talk about CPI in 6 minutes, and I have a lot to talk about. CPI, PPI, and PCE. When we trade stocks, let's say buying Google. Google announced layoffs yesterday, and the stock went up. 4,000 less people were paid, and great, Google stock went up. We don't talk about Google going up and Apple going down. If we did, we would be considered in the stock market called an arbitrage trader. It's a really sophisticated way to trade the stock market because we're taking two companies and we're comparing them against each other. The best example I could give in arbitrage trading I think it's way trader is when you go long a strong company, strong fundamentals like AAPL, that's Apple, and sell short a weaker company or weaker fundamentals such as RIM, R-I-M-M, which makes the BlackBerry. And if you were to, I don't have the chart in front of me, but if you were to look at a chart, and if you were to buy Apple Computer 5 years ago, and at the same time you would have sold short RIM, that makes a BlackBerry 5 years ago, and 4 or 5 years ago, or 2 years ago, or 1 year ago, based on the premise that I think Apple makes a better iPhone than RIM makes a BlackBerry, well, fantastic. That's an arbitrage trade, and you would have been very, very right. If you were to go long Ford and sell short General Motors, that's an arbitrage trade. Every Forex trade is an arbitrage trade. We take it for granted because it's so easy. We're buying the euro and selling the dollar. Now, in the Forex market, we're talking about the globe, there's a finite amount of capital. So the investment money that we choose to invest in Australia, we have to take out up from somewhere else. There's no such thing as capital that exists outside of currency. Your capital is either in a dollar or in an Aussie or Brazilian real or whatever currency. So there's a very finite amount of capital that is always making the decision based on these economic numbers, what's better than the other. So let's talk about specifically unemployment. And obviously lower the number, the lower the number, the better. We're going to try to identify those unemployment levels that are better than the moving average. The moving average, by the way, it's all it is an average of all the different 8 unemployment levels put together. That's the black one. That's right in the middle. Okay? So this is a very unscientific approach. I didn't read this in any economics, book. This is just kind of something I put together on my own. And I'm sure there's a lot of economists that can do a much better job at, really, really discussing this. But this is economics for, we're Forex traders. We're not economists. So we're still trying to focus on identifying the trend. The trade. Okay, so the employment numbers. We're looking for the unemployment rates better than average. Okay? And those will include, we're starting at the bottom, obviously. The purple line is the Swiss franc. The yellow line is the Japanese yen. The blue line, the dark blue line, is the Aussie currency, obviously representing Australia. And the New Zealand dollar, the red line, the Kiwi, is on the moving average. I'm going to give it the benefit of the doubt, though. I'm going to say it's better than the moving average. Okay? We're going to take the bottom 4. Those are unemployment rates that are better than the average. Now, a real fundamental analysis, and let's before I go off on a tangent, let me see the unemployment rates worse, higher than average include, well, the rest of them. The green line is a Canadian dollar, the white line is a US dollar, the orange line is a British pound, and the light blue line at the top is the euro. Now, a real fundamental analyst, a real economist will say, well, this is not a fair comparison because we have different countries with different cultures, and those cultures affect the employment practices. And, a very easy example is you take a look at, a lot of countries in Europe. And a lot of countries in Europe, culturally speaking, children tend to stay in their parents' house for a longer period of time. In the U.S., not now because the economy is really bad in the U.S. And, kids graduating high school and college, they kind of need all the help they can get. But in the old days, 5 years ago, it was not uncommon it was actually quite normal for someone 18 years old in the U.S., you graduate high school, you're out the door. You might go to college, you might go to the military, you might get a job or whatever you're going to do, but you're out the door. In a lot of places in Europe and a lot of places outside the U.S., that's not really the case. Those cultural differences will affect unemployment levels. And I think naturally that's why you're going to have unemployment levels. I think probably naturally they'll be a little bit higher in Europe than they will in the U.S. I think you also have in Europe a lot of employment is a lot more union-based, so that when you get a job, it's more of a job that, that maybe you're going to hold on to for a long period of time based on that pension. And I think the pensions, they kick in probably a lot earlier in a lot of places in Europe than they do in the U.S. In the U.S., we have pensions if you work for the public sector, but in the private sector, it's called a 401k. It's a personal retirement plan. And, a real economist will also take a look at the differences in, how many different jobs does the average American versus the average European have? And I can tell you from personal experience, in the first, 5 years graduating, university, I probably had 5 different jobs. I mean, that's just, I think that's more of a cultural norm in the U.S. that within the first couple of years, people tend to jump around from job to job, trying to make a little bit more money or to find exactly, what they're looking for. So a real fundamental analyst will take a look at this and not just look at these lines at face value. For our purposes, we only have a short amount of time to talk about this today, so we're going to look at these at face value. If you're really interested in the true economics, then you would have to take it, a step further. It's really fascinating stuff. But nevertheless, we can make assumptions based on this chart. We can say those economies that at the moment seem to be employing the greatest percentage of the workforce include Switzerland, Japan, Australia, New Zealand. And we can say those economies that are really, falling under a lot of trouble right now include Europe, the U.S., the UK, and Canada, which is a green line. And in addition, if we really wanted to do this the right way, we would also consider the angle of ascent or descent. Take a look at the euro unemployment level, and this is for the eurozone. Okay, the light blue line at the top. It's at I think it's 11.2%. It's almost making new highs almost every single month. Month after month after month, it just continues to make new highs. In the U.S., we had unemployment levels that hit, I believe the peak was 10.1%. Since then, we've come down. We're hovering above 8%. It seems to be a real sticky point over there. But we're, definitely 2 percentage points off the high. The UK unemployment rate, it's not at the high, but certainly it's in an upward trend. Canada looks like it's a little bit more like the U.S. We hit those peak highs, not as high as the U.S., but since then we've come down. Okay, so we can, we can look at the trends like a technical analyst will. We can also look at the trends and say, well, which way is this going? That's even too much analysis. I don't want to overanalyze this chart, but I'm sure you're starting to see there's an unlimited amount of ways that we can consider this. Question: do you say the high interest rates mean a good economy? What about Greece? There are 2 types of economies when we talk about bond markets. In a normal economy, Normal meaning a healthy economy that we do not fear defaults. Bond yields tend to go in the same direction as stocks. When the stock market goes up, the bond yields go up. When the stock market goes down, the bond yields go down, because bonds pay a higher or lower yield to compete with the stock prices. That's under the assumption that that bond will pay its investor back. That is the case in the U.S., in Germany, in Australia, in New Zealand, in most of the countries we're talking about. And in the U.S., we have bond yields at 1.69%. In the U.K., 1.58%. In Germany, 1.44%. Okay. In countries where there's a very high risk that the country may not be able to pay back its investors, all of a sudden that flips upside down. That relationship flips upside down, because an investor says, no, I'm not going to buy a Greek bond. I've been reading in the newspaper that they're in a lot of trouble and they might not be able to pay their investors back at all. There's no way I'm going to buy a Greek bond at 1.5%. I'm demanding 10%. Greek bonds right now pay 24% yields, because there's a very good chance that those bond investors won't be paid back. That's in a very risky economy. The magic level, if you want to kind of determine if the economy is healthy or not, it's 7%. If those 10-year, and there's 10-year government bond yields is what I'm talking about specifically. If the 10-year bond yield is above 7%, 7% is that magic level that countries have. Once that bond yield crosses above 7%, that country usually needs a bailout. We've gotten to a really scary point last month when Spanish bond yields went up to 7.5%. They're back down. They're 6.74 now. Above 7%, danger. Below 7%, more or less normal. So the Greek bond yields that pay 24%, they're paying 24% because investors, they're not very optimistic in their chances of getting their money back. It's a great question. Okay, so we have unemployment, and we're going to keep these currencies in mind. Again, those currencies represent countries that have better than average unemployment levels. Include, what do we say, Swiss, yen, Aussie, Kiwi, worse than average CAD, dollar, pound, euro. But government bonds should guarantee a return. I agree, they should. There's a lot of Greek bond investors that will agree with you. They'll say, hey, the government should guarantee my bonds. But the governments, oftentimes, they default on their bonds. 7% is just that level that the market has decided that I don't know why it's 7%. It's just a level. It's the resistance, for lack of better words. Often we hear about magical 7%. Where does it really come from? Seems to be in dead nations have a really hard time paying back debt. Well, you think about it, put it on personal terms, and I don't want to get too far off topic, but we have our own personal finances. We have a credit card bill, and we have a mortgage, and we have a job to pay for all this, and all that's great. Well, imagine that one day we're working 40 hours a week, and we go to work, and they say, well, guess what? We don't have enough money to pay you 40 hours a week. We can only pay you for 20 hours a week. Well, that means we have less money to go around, less money to pay our credit card balance, less money to pay our mortgage and to eat and everything else. But imagine if all of a sudden the bank, no. Let's say we come home, we get a piece of paper in the mail from the credit card company, and the credit card company says, I just noticed that you're not working 40 hours a week anymore. You're only working 20 hours a week. And your credit cards that we were charging you 5% interest rates. Well, we don't feel very confident that you're going to be able to pay us, the credit card company, back. We are taking a lot of risk by extending that loan to you. You want to borrow more money from us? No, 5% is not enough. You need to give us 7%. You got to give us 8%. What does that do for us? That's not what we want to hear. Thank goodness that's not really the case. We don't lose our job and come home and find out the credit card is raising interest rates because we lost our job. And let's say we go from 20 hours a week down to 0, we get completely unemployed. And then we get a letter from the bank saying, listen, I noticed you're unemployed, and your 5% fixed 30-year mortgage is now 10% because, well, you're considered a subprime borrower. Our interest rates on our credit cards and our interest rates on our house Well, they don't fluctuate on a daily basis. The bond market does because every day people are buying and selling bonds. So if Portugal today and Portuguese bonds right now pay 9.94% interest rates because the market, which is the buyer, it's not one individual, it's all the buyers and sellers in the world. They have determined that given the amount of risk, the probability that the Central Bank of Portugal will be able to pay back their bond investors that have already purchased Portuguese 10-year bonds, they have determined that 9.94% yield is the appropriate yield given the risk versus reward. But if Portugal comes out tomorrow with some kind of really bad news, says, guess what? We thought GDP was going to be here, now it's going to be there. It's going to be a lot worse. Well, guess what? The bond markets are going to say, no, I don't want to buy Portuguese bonds anymore. There's less of a chance that the government's going to be able to pay them back. It's not an absolute yes or no, but a little bit of a less chance. Those Portuguese bond yields are going to go up. More of a risk. Great questions. The second component is inflation. We talk about inflation, CPI, PPI, PCE. The Consumer Price Index, Producer Price Index, PCE, Personal Consumption Expenditure. What's the difference? A Consumer Price Index measures a basket of goods and services that represent the average consumer. I don't know what those are. It's very easy to find out. And it's a weighted index, but I'm assuming it involves a loaf of bread and a gallon of gasoline and a cell phone and a laptop computer and, a pair of sneakers and, bouquet of roses, whatever represents the average consumer. And that's on the consumer level. When the economy is strong, the CPI goes up. Why? Because the consumer can afford more. There's more demand than supply. The store or the business says, hey, look at all the people coming in. Let's raise prices a little bit. We can afford to do so. The producer price index is the same basket of goods and services, but at the producer level, it's also called the wholesale level. That means how much those roses, if you're going to buy a bouquet of roses, the consumer buys the bouquet. The producer price index is how much a store that puts together that bouquet of roses, how much do they actually pay for the raw materials? If we're going to buy a laptop computer, how much do the raw materials cost to create that laptop? And we have the CPI, PPI, and core CPI and PPI. Core inflation excludes more volatile components of inflation, i.e., food and fuel. The easiest way that I can talk about this is I call this good inflation and bad inflation. Good inflation is inflation that when it goes up, it's good for us. It's good for most of us. Good inflation is when a TV goes up in price. When a flat screen TV goes up in price and a computer goes up in price and a notebook goes up in price. Books go, regular stuff that most of us consume every day. But it's good because most of us think of the average employee works in a store that if the price of a computer goes up, chances are we're going to benefit from that because most of us probably work in some kind of store that's involved in selling computers or, sneakers or clothing or whatever it may be. That's good inflation. That shows the economy isn't strengthening. And it's to a point. We don't want inflation to go uncontrollably. We don't want a flat screen TV to go from $1,000 to $5,000, per TV. That's why we have central banks that raise or lower interest rates. Housing is also a very big component. You are correct. It's a really important component. And actually, great points. Think about the stock market. Think about the housing market. When the CPI goes up, our home value goes up. Our stock prices go up. That's great. That's what we want to see. And if we work for Dell Computer or if we work for Nike sneakers and the prices of sneakers go up and the prices of Dell computers go up, Dell makes more money. I own Dell stock. I really don't. But if I did, my stock price, my shares would go up. Nike stock, they would also go up. That's good inflation. Bad inflation occurs when inflation goes up, but it hurts us more than it helps us. That specifically is food and fuel. When the price at the gasoline pump goes up, most of us don't make money unless all of our money is in oil companies. And when the price of food goes up, well, that's bad for most of us unless we happen to work in the farming industry. Most of us don't work on farms. Most of us don't work for ExxonMobil. So when the price of the gasoline pump goes up and the price in the supermarket goes up, that's not good for us. That's the difference between inflation and core inflation. Core inflation does not include food and fuel. So essentially, we want core inflation to go up more than regular inflation. Take a look really quickly at the economic calendar today. I always run out of time. I failed to get to the point. Take a look at today's PPI, 0.5%. We have a year-over-year and a month-over-month basis. I like to look at the year-over-year figures, the bigger sample size. Year-over-year, from this point this year to last year this time, last month, the PPI, Producer Price Index, wholesale prices were up 0.7%. We were expecting an increase of 0.5%. The actual number, we came in line, 0.5%. Ex-food and energy year-over-year last year, this time, 2.6%. We're expecting 2.3, and it's actually 2.5. So we missed. The PPI came down on both counts, but we beat expectations ex-food and fuel, which means the price of a computer and the price of sneakers, the good inflation, went up a little bit more than food and fuel did. Good news. That shows us the economy. This is a good piece of news for the U.S. economy because it shows us the core inflation went up more than regular inflation did at a faster pace. How do I know this? Because we beat expectations from 2.3 to 2.5 on the ex-PPI versus normal PPI, 0.5 versus 0.5. Point being is that if I'm guessing that the price of food and the price of fuel went down, gas prices and food prices probably went down a little bit compared to everything else. It would be a lot better if we actually saw an increase. I mean, the ex-food and fuel, it actually did not rise. It actually went down a little bit, but there's more of an increase, or there's less of a decrease taking out food and fuel. Okay? Now, PCE, the Federal Reserve was not happy enough to leave that alone. They had to throw something else into us. I think the U.S. is the only country that uses the PCE, which is personal consumption indicator. Okay? PCE is basically the same thing as CPI, except there's one very big difference. If you have time, and you need a lot of time, Google the difference between CPI and PCE. You're going to get a lot of personal consumption expenditure. The difference is the PCE, it allows for substitution. Okay? The best way I heard this explained once on Bloomberg, I believe, and the analyst was talking about this. Let's say it's back in 2007, we're all making a lot of money. We go to New York City and we want to go to have a steak dinner. We go to one of the best steak houses in New York City. We go to Peter Luger's and we buy a steak dinner and it's $150. Beautiful. That's a CPI. Now, fast forward 4 or 5 years and we lose our job, we lose our house. We're really in dire straits. But we still want to go out and have a steak dinner. Well, if we were to go to Peter Luger's, we're not gonna spend $150 on a steak. We might just get a house salad. That CPI will go down because we're spending less money, and the price of that steak is going to go down. The PCE, which to be honest, I don't like. The PCE allows for substitution. It says we understand. I think it's not the Bureau of Labor Statistics, but it's some organization in the U.S. We understand that times are tough and individuals might not go to the best steakhouse. We're going to go to Applebee's. It's not the worst place, but it's not Peter Luger's. So as a result, we're spending $20, $25 on the steak, and 5 years ago we were spending $150 on the steak. The CPI would go down.
the PCE might not necessarily reflect that. Because 5 years ago I'm spending $150, now I'm spending $25. The CPI is more of a blind indicator. It says we're spending more money before, we're spending less money now, the CPI goes down. The PCE says, no, he's still having a stake, it's okay, it's just at a different place, we're going to allow for that substitution. The PCE is what the Federal Reserve in the U.S. uses. We talk about this during the central bank meetings when the Federal Reserve announces interest rates and they announce their projections. They use the PCE. I don't like it. I'm very suspicious. I think the Federal Reserve doesn't want to tell us how bad the economy in the U.S. really is. So they're allowing for the substitutions. I think the Federal Reserve, and I don't want to go off on a tangent here, it's some sort of monetary policy conspiracy theory here. But the fact of the matter is, if we really want to get a true gauge of the strength of the economy, compare how much money I'm spending today to how much I was 5 years ago. It's a lot less. If you allow me to substitute one restaurant or one product for another, I'm not buying the same steak. It should not be an equal comparison. That's my opinion. All right. So that's the difference between the CPI and the PCE. Let's rank CPI better than average. Those average include those currency lines above the moving average, which include the orange line, which is a pound, the light blue line, which is a euro, the white line is the US dollar, the green line is a CAD, and the blue line, the dark blue line, is the Aussie. CPI below average include Japanese yen, New Zealand dollar, and Swiss franc. Okay, again, a true fundamental economist is going to take a look at this information in a lot greater detail. You could write a PhD thesis on on this kind of stuff, on these three charts. I have another one as well on this subject. You know, what are the cultural differences that affect consumer prices in the UK as opposed to the rest of Europe, as opposed to the US? What do they generally consume? Japanese are known to be a saving economy, an economy of savers. You know, so they're going to spend a lot less. They have a lot less debt than the average American does. So, you know, we're only scratching the surface. If you really want to, you know, do this the right way, then you really have to look into much greater detail. We're only scratching the surface. I'm going to give you a link to the entire article that has all these charts as well. It's all in the FX Sheet website, by the way. Okay. Well, I'm running out of time here, so I don't want to get too far down. I think we've exhausted. Last is growth. Gross GDP, gross domestic product. It measures all the goods and services. Basically the business, the rate of growth in a country. This is measured on a quarter-over-quarter basis. One disclaimer, the CPI data was all on a year-over-year basis. I think the New Zealand current data, I could only use quarterly numbers. They did not provide a monthly update. But, you know, we're not perfect here. GDP shows that the rate the economy is expanding. Oh, by the way, the previous chart, the CPI, if we really wanted to do a good job, we would also take a look at the rate of increase, of incline or decline. Take a look at the CPI, how much UK CPI has really crashed over the past couple months. Didn't we just have Olympics in London? Shouldn't consumer prices be rising in London? Where would CPI be without the Olympics? I mean, you know, there's a lot of people that went to London and went to a lot of hotels and restaurants and, you know, bought a lot of Olympic T-shirts. Shouldn't the CPI be better? I'm very skeptical of this. Euro, US, Canada, Australia, CPI numbers moving sharply to the downside over the past couple of months. What has not? What has been more resilient? Swiss, yen, and Kiwi CPI. GDP. GDP above average includes not a lot. US dollar, Canadian dollar, Aussie. GDP below, and by the way, this article was written yesterday. We have some new data today, which I hope I'm going to have time to get to. GDP below average includes pound, yen, Swissy, and Kiwi is on average. The Kiwi, I would actually like to give it the benefit of the doubt. GDP above average includes dollar, CAD, Aussie, and Kiwi. Let's give it the benefit of the doubt. I like it. Okay. Now, we have three numbers: employment, inflation, gross domestic product. Put those three together. Let's try to find those currencies that have the most amount of positive data and those currencies the most amount of negative data. And I actually took some notes here. Let's see if I can, because I did this before. I'm running short in time here, so I mean we could look at these individually, and that's why I chatted them all in. But we have in Australia, we're 3 for 3. All those numbers are above the average, right? The unemployment level is below the average, which is good. The CPI is above the average, which is good. And the GDP is above the average as well. We have the US dollar. We have 2 for 3, which means that the CPI is above the average, the GDP is above the average, the unemployment level, it's above the average also, and that's bad. So it's not a perfect scenario here. We have New Zealand. Remember, we gave it the benefit of the doubt. And I think we're basically 3 for 3. No. We're 2 for 3. 2 for 3. Okay? Those are the strong. Oh, we also have Canada. With Canada, the unemployment level is above the average, but the green line, the CPI is above the average and the GDP is above the average. So Canada, we're 2 for 3. And again, what does 2 for 3 means? It means that at least two of those three barometers are above the average. We have 8 currencies we're watching. What's the average unemployment level? What's the average CPI level? What's the average GDP? Is it better or worse than the average? In Australia, we're 3 for 3. The unemployment level, GDP, and CPI are all better than the moving average. In the U.S., New Zealand, and Canada, we're at least 2 for 3, better than the average. Okay? This tells us something really, really important. I mean, especially in Australia, that these economies, for whatever reason, I'm sure there's some cultural differences between the two, between all of these, but, whatever these countries are doing, they're doing the right job. What about the euro? The euro is a light blue line. The euro, the unemployment level is at the highest, so that's definitely below the average. The CPI is better, but the GDP is worse. And if you take a look at today's economic calendar, by the way, Eurozone GDP quarter over quarter, quarter over quarter basis, we saw a decline of 0.2%, ladies and gentlemen. Eurozone GDP is now negative. It's worse than it was last month. Last month, we were just a little bit above positive. We're at 0.7%, I believe. So euro, we're 1 for 3. Only the CPI data is above the average. And if you take a look at the rate of decline, it's not good. Okay? Let's go through really quickly. Pound. Unemployment level is above. That's bad. The CPI is above the average, but take a look at the rate of decline. I mean, we're not even going to talk about that. That's a huge move to the downside. And the GDP number is the weakest. The UK actually has a worse GDP number of the list. Okay? Australia, New Zealand, Canada, we talked about. Switzerland. Switzerland is the purple line here. The purple line, the best unemployment level on the planet for the G8 currencies in Switzerland. The lowest. They're doing something right. CPI is the lowest also. That's not good. And the GDP is the lowest, not the lowest, but definitely near the low. So Swiss franc, although they have the lowest rate of unemployment, they're only 1 for 3. Japan. Japan. We have the Japanese unemployment level. It's the second best, actually, and that's good. We have CPI, Consumer Price Index, that's below. GDP also below. So Japan, 1 for 3. If we have currencies, and it's 4 for 4, we have 4 on the top and 4 on the bottom, makes it easy. The 4 on the top include Aussie dollar, Kiwi CAD. The 4 on the bottom include Euro, Pound, Swiss yen. And well, there's a lot of assumptions, a lot of conclusions we can draw from this. But you know, what's one observation we can make? We can say, well, commodity-based currency have been doing well. Aussie, Kiwi, and CAD all export commodities. Australia exports commodities, metals. New Zealand exports soft commodities like corn and wheat and all that good stuff. Canada exports crude oil. Now, you know, if you can talk about commodities, you have to talk about China. What if China slows down? What is that going to do to Aussie's exports, or the demand for Aussie's exports? Talk about the weaker economies, like and a lot of them, all of them, I should say, or no, not all of them. All of the European currencies are at the bottom end of the list, the Euro, Pound, and Swissy. As a Forex trader, we want to match the strong currencies to the weak currencies. So you pick one from the top of the list, one from the bottom of the list. And I don't know how to do that, but there's probably about 4 times 4, so 16, no, there's more than probably 16 different currency pairs. You can begin to construct a currency pair from a lot of fundamental analysis that makes sense. Who would have thought the pound Kiwi was a good currency pair to trade? Now, it wouldn't necessarily jump up and down because the spreads are very big. But you take a strong currency and a weak currency and put it together. You could take a look at the pound Kiwi. Look at the Euro Kiwi. Look at these trend lines. They're unbelievable. Get the Aussie Swissy, straight up or straight down. Now, why would I not want to trade the Aussie CAD? Because the Aussie and CAD both have relatively good fundamentals. Euro Yen, well, not really a currency pair that's very appealing. The yen crosses do tend to move, but there's not really a lot of reason to do so. The pound yen, Swiss yen. Why would I want to trade the Swiss yen? Look at this range-bound market. I mean, this is unbelievable. Compare the Swiss yen. Look at this range-bound mess. There's nothing appealing about trading the Swiss yen. We don't even need this line. We can see this range-bound mess. You buy and sell, we're going to lose money all day long. Compare that to the Aussie Swissy. If you bought, you made money. If you shorted, you lost money. But you would know almost immediately. Pound CAD. Pound Aussie. Take one strong and one weak and put it together. Pound Swissy is flatlined. Now armed with our fundamental analysis, is there any surprise? I mean, it almost makes it really, really easy, right? Pound Swissy. Daily charts. There's no reason to trade this. I mean, I know there's a little bit of a move to the upside, and there's a lot more. Sorry, you meant Euro Swiss. Euro Swiss is the greatest example. The Swiss National Bank has been intervening, so there's a lot of other reasons why, the Euro Swiss is not moved. But why would we want to trade this? It's not worth the risk we're taking to trade the Euro Swissy. Why trade the Euro Swissy? If you were to, and the easiest thing is to say, well, what if I were to buy the Euro Swissy in one account and sell short another account? Would I have made money, or would I have lost money, or would have probably nothing happened? Compare and contrast that to the pound Kiwi. I mean, that is a beautiful chart. If we had the foresight to look at the fundamentals and say, I think that the New Zealand economy is in a better state of affairs than the UK economy, and the beauty is, I mean, these numbers, they don't occur every day. We're talking about 3 big numbers: employment, GDP, which GDP, by the way, if you want to look at the true GDP number, it's only quarterly, once every 3 months. The unemployment level and the CPI level, it's on a monthly basis. So you have 10 numbers a month to look at, and obviously these numbers don't move a lot. You take a look at this, the unemployment level going back. New Zealand has been below the UK for as long as this chart goes back to 2007. And even the rate of change, the unemployment level, going back to 2010, dropped a lot more in New Zealand than in the UK. It's not a mystery how someone would want to take their capital, take it out of the UK, put it into New Zealand. How about the consumer price index? Well, the CPI in the UK did go up more than it did in New Zealand. But over the past couple of months, it has come down at a much faster rate in the UK than it did in New Zealand. And the GDP GDP is negative in the UK and has been inclining, has been moving to the upside in New Zealand. I mean, this is not a surprise. These are macroeconomic, events that occur. Now, if we really want to do a good job at this, we say, well, how can I better judge if the CPI is going to go up or down? Then we take a look at the components of the CPI, like housing, like retail sales, like all that other stuff that goes into the housing market, or goes into the CPI. What about employment levels? Well, the unemployment levels release every month. But in the U.S., we have initial jobless claims every week. We have ADP employment services. Gross domestic product. Well, there's an unlimited amount of ways that we can divide that. Not to mention, if we're talking about the Eurozone, well, we have 17 countries that use a euro currency. Spain, Portugal, Greece, etc., Italy, etc. 27 countries that are in the EU that don't necessarily use a currency, but are in the EU. Norway, etc. I don't know if it's Ukraine, Czech Republic, etc. Within the U.S., we have, those states with strong economies. In New Jersey, the economy is really improving. Florida, the economy is really improving. We have states with a really big budget deficit, like California and Illinois, and a lot of them. So obviously, you can see there's an unlimited amount of ways we can dissect this. Let's start with the big picture. And I know that we're really supposed to talk about technical analysis as well. But like I said from the beginning, technical analysis is actually pretty simple. We find the trend, we draw trend lines. There's a million different ways that we can find the entry. Where am I going to sell short the pound Kiwi? I might choose a moving average, or a trend line, I should say, or I might use the Bollinger Bands, or I might use the Relative Strength Index, which is the RSI, or I might use the oscillators MACD. All very good tools. You can make a lot of money with any of them. If we were to sell short the pound Kiwi based on the RSI or the MACD or the Bollinger Bands, they all basically gave us the same sell signal. And the trend line as well. Now, I think we obsess too much about the technical analysis side of it. But the fundamental analysis tells us, well, definitely don't buy the pound Kiwi. And the fundamental analysis also tells us, remember, our goal is not only to find the right trade, but know when should I close this trade? When should I take profits? When should I get in? When should I get out? Well, the fundamental analysis, does a good job of doing that. Today in the UK, economic calendar shows us UK Consumer Price Index, year over year, we're expecting 2.3%. Last month, 2.4. The actual number, 2.6. UK Consumer Price Index shows an improvement. We go to our trusty chart. UK CPI, a big slide to the downside. It got a little bit better today. Now we put on our economist hat and we say, well, what does this mean? We're 2.6%, we were at 2.3 or 4. Does this mean a change in the trend? Is this a result of the Olympics or the closing ceremonies and everybody went out to eat? Or is this something big? Then we go back to our pound Kiwi charts and we say, okay, overlay that with a technical analysis. Maybe I should place my stops above the moving averages. Maybe I should place my stops near the Bollinger Bands. We are able to, develop a much more educated opinion about what we should trade, which direction, and what we should do. Questions. Using a fundamental approach, what time frames do you consider? How long do your trades typically last? Personally, I love long-term trading. I say, why take a day trade and take the risk and make 20 pips when I'm looking at the fundamentals and I see how bad the CPI is declining in the UK? And I'm saying, well, what if New Zealand CPI improves? It actually was to an extent. You take a look at this contraction. That's a lot of businesses closing shop in the UK and opening them in New Zealand. This could continue. So, there's a lot of, to answer your question, there's a lot of factors that I use, to make the decision. And of course, when the market gets oversold, extremely oversold or overbought, we're going to take a little bit more profits. Or if the fundamentals really change, we're going to start to take profit and close the position. But I'm going to hold on to a trade as long as the market, from a fundamental and technical point of view, tells me to do so. And I'm sorry to be so non-specific about it, but I'm sure you can see there's a lot that goes into the decision. If the UK fundamentals start to get a lot better all of a sudden, and New Zealand starts to get a lot worse, and the technical analysis, we start to break trend lines, I'm going to, you'll develop, traders talk about a gut feeling. It's not a gut feeling. All it is that I'm looking at what the market's giving us. The economic calendar is telling me that things are not good in the UK, and they're a lot better in New Zealand. It's an obvious decision. Some people argue that everything you need to know about currency and economy can find the chart. I disagree, and I'll tell you why. You take a look at this pound Kiwi chart. I'll erase all the indicators, and I'm going to erase all the trend lines and everything, okay? So let's say we cover up. We don't know what this is. We don't know this could be the pound Kiwi, or this could be Apple Computer. What is this chart? It was going up and it went down. Apple Computer, the fundamental analysis tells me buy here. Buy on support because we're going up. It's Apple Computer. Pound Kiwi, the fundamentals tell me don't buy, sell shorts. Fundamental analysis is important. It does not, you can make money without it, but I think you have a better chance of making money with it. Sometimes I'll hold on to trades for months. I've been short the euro currency against a lot of other currencies for months. Same with the pound. Longer-term FX trading easier than swing to short-term trading for people who don't like fundamentals. But there's nothing not to like. It's interesting stuff, If we're going to bet on the sports team, wouldn't we want to know if the athletes are in tip-top shape, or if some of the athletes had just gotten in a car accident and have back pains or going through a messy divorce? It's more information. What's that quote from the movie Street? Information is power? Something like that? I forget. I'm out of time. If you want to contact me directly, www.forexlounge.com. I want to thank you all very much for joining us. Oh, let me give you the link. Please see FX Street's calendar because we have a lot more to talk about. This is the link with all those charts together. Again, we thank you for joining us. We wish you a great day, all profitable trades, and we look forward to seeing you back soon.